Hello, I'm Monene Watson, CIO at Old Mutual Multi-Managers. Our equity solution on the local side has done very well for clients over the last number of years. If you look at the short term, medium term, and longer term, we've outperformed our benchmark on a net of fees basis. But it's important to look at the reasons for that. Oftentimes we focus on what's happening when things go wrong or there's underperformance. But Michael Dodd, who's here with me today, has done some interesting research in this space, looking at what the environment has been like in which managers have done a whole lot better against their benchmarks. So Michael, we know that our managers as a collective have done well over the last number of years, but if you look at the industry as a whole, how have equity managers performed?
Yeah, thanks, Monene. So, firstly, as part of our investment process, we regularly review our asset classes, our managers, and part of the work that we look to do within the South African equity space more recently was to understand the market environment in which our managers have been operating. And we found that in firstly seeing our managers do well, we also observed that the general manager in South Africa was also doing a lot better than they have historically. So we looked at the ASISA South African equity general category as the sort of the catch-all category for all of the South African equity funds, and compared the returns of that particular universe to our equity benchmark. And that sort of work comes with all the caveats of survivorship bias and not all managers having the same investable universe and benchmarks. But what we observed was quite an interesting trend in that more recently, say in the last 3 to 4 years, that more managers were outperforming their benchmarks than they have historically, particularly since 2017. 2017 was a particularly bad year to be an active manager in the South African equity space. But what we observed is an improving trend, where to the point that at the end of 2021, on a 3-year basis, the median South African equity manager has actually outperformed the Capswix benchmark. The Capswix benchmark would be a third quartile manager in that particular space, which was something quite interesting that we saw in the numbers.
Yeah, it is interesting, and also in the debate, the kind of rhetoric is that active managers can't outperform. So when the work you've done, what are the insights that you've gained in terms of why managers have done better in the last few years?
Yeah, so I think we observe this trend, and then we want to understand, okay, well, why has that been the case? Have we just picked really good managers, which we do, but also has the environment been favorable for active management? And I think firstly, I just want to credit some of the research and the industry research that we lent on in looking at this. So firstly, the interactions that we had with one of our local equity managers, Sentio, was really helpful in this, and also a research paper that was done by Macquarie a few years back. And what that paper concluded was that there are two dynamics or two variables at play that impact the ability for active managers to outperform or are amplifying factors. The first is dispersion, and the second is market breadth. So maybe just to give some definitions as to what those are. So firstly, dispersion, or the dispersion of stocks, basically measures the gap between your best performing and your worst performing stocks in the market. It's typically measured by the standard deviation of cross-sectional returns, or what is commonly called cross-sectional volatility. And why it's important is that when dispersion in the market is high, there's a greater difference between what different stocks are or what they're doing. So where dispersion is quite low and narrow, and all stocks are giving you effectively the same return, then it's very difficult for an active manager to differentiate themselves from one another. And the differences between skilled and unskilled managers are minimal. They effectively look the same. So dispersion is an important differentiating factor for active managers. And what the Macquarie paper concluded was that it's actually it's a leverage factor. So it's not necessarily a good thing, but it's a good thing for skilled managers. So if there's high dispersion, a skilled manager can differentiate themselves, but if you're an unskilled manager, then it can have a commensurately negative effect as well. And the work that Sentio did for us in looking at the cross-sectional volatility of our market showed that cross-sectional volatility in the South African market has been a little bit higher than average over the course of the last few years. So that condition has been there in the South African market, which has helped skilled active managers. The second is market breadth. And market breadth, quite simply, is measuring the number of stocks that are outperforming the benchmark versus the number of stocks that are underperforming. And it's quite closely linked to skewness and the skewness in the distribution of the returns. And where a market's return distribution is positively skewed, then it's an environment where there is narrow breadth.
So, Michael, you covered a lot of very interesting things quite quickly. Can you just give us an example of where this dynamic of positive skewness, or periods in which this has played out, and kind of what the impact has been on returns?
Sure. So positive skewness or skewness in the return distribution, and Macquarie used a very simple example to illustrate the point. And they took a hypothetical market index of 3 stocks that are all equally weighted. And if one stock returns 30% and the other 2 give you 0, the market benchmark return quite simply is 10%. But your probability of outperforming if you chose one stock at random is quite low. So if you choose one stock at random, the probability of outperforming is only 1/3, because the other 2 stocks are below what the benchmark return would have achieved. So skewness effectively, or breadth, affects your probability of being able to outperform. And market breadth is quite closely linked to concentration and concentration of a benchmark. So what we've observed in the South African market historically has been that South Africa has quite a concentrated equity benchmark. And concentrated benchmarks typically come with quite narrow breadth. And if you're building a diversified portfolio, as our managers look to do with diversification across not just instruments but sectors, in a market where there is very narrow breadth, it's quite difficult for those managers to outperform. And the South African market in particular historically got more and more concentrated over time, with the growth of Naspers and historically with the impact that certain resource companies had in our market. What we've observed more recently has been a few things that has caused breadth in the market to improve. Firstly, the South African industry, or the South African market, moved away from your more concentrated benchmarks to your capped benchmarks, like the capped SWIX, which is the benchmark that we use that addresses the concentration risk. We've also seen, in the case of Naspers, some actions that have reduced their prominence within the South African benchmark, where they unbundled their holdings in multi-choice and process, which they spun off separately, but also they subsequently have underperformed, which has reduced their prominence in the market as well. So there's been a number of conditions in the South African market in the last few years as well, where breadth has improved, as well as the higher dispersion. So we've had both of those conditions in the South African market, where a skilled active manager can leverage their skill in an environment where the probability of outperforming has been a little bit higher.
So the environment has improved, but at the end of the day, you've had to have the necessary skill to leverage that improvement over time. Which brings me to another issue that I wanted to talk to you about, and that is our boutique portfolio, or our portfolio of boutique managers. We launched that portfolio in 2016. People might or might not be familiar with it. It was there to perform a specific role. It has very different kind of managers. So maybe you can just talk to us about that portfolio, because the performance has also been exceptional. What are we trying to achieve with it? What kind of managers have we included?
Yeah. So, and with an emphasis on the skilled managers that sort of spoke about in the last few minutes. That boutique portfolio, particularly on the retail side, that we launched in 2016, it's a collection of smaller managers that come from hedge fund backgrounds. The funds, those portfolios are housed in the Old Mutual multi-managed equity fund. It currently consists of 3 managers, being 361 Asset Management, Bataleur Capital, and Laurium Capital. And it's a portfolio that's done very well. And in terms of the role that it plays within our building block, these are managers that differentiate themselves from the more traditional managers in that they are a little bit smaller, they're a little bit more nimble, they can play in areas of the market that the larger asset managers can't necessarily play in to the same degree. And given the hedge fund mindset and the background that they've had, it's a different thinking, and they bring something quite different to the overall building block, and in terms of the value that they've added, particularly in the market environment that we've had, where it's favored your skilled active managers. They've been one of the top performing portfolios within our overall building block, and have added a lot of value in our clients' portfolios.
Thanks, Michael, for joining me. If I have three takeaways from what we've discussed today, the one is that the environment changes over time. So one's not always going to get a consistent environment that's conducive maybe to, the level of alpha that we've had now. But if one can pick skilled managers, and that's the real trick, and what we as a business, try to bring it for our clients and our portfolios, then you can really benefit from that. But the third point is probably the most important, is that one doesn't know how the environment's going to change. So it's about having a long-term view. Because if we look at our portfolios over the long term now, net of fees, we've had a really good outcome from active managers. And particularly this year, when markets have been particularly weak, that kind of outperformance has been a real protection factor in our portfolios for clients. So thank you very much for sharing those insights with us.